Welcome and thank you for joining me for the Providence Quarterly Outlook and Strategy. I thought I'd take this opportunity to run through with you the current thinking of our investment committee. There's three areas I'd like to cover: the investment overview, valuation of assets, and more importantly, how to navigate. In the past 6 months or so, there's definitely been a change of narrative. We have seen the discussion going from deflation to reflation, from falling interest rates to rising interest rates, from monetary policy to fiscal policy, and in some quarters, from globalisation to protectionism. So while a change is apparent, the investment implications are unknown. Therefore, we believe it's still prudent to remain cautious and retain a high level of cash to deploy in any market weakness. When running through the various asset classes, despite a pickup in global growth, markets have tended to run ahead of themselves. An example of this is in the US, where the US equity market now trades on a PE, a Shiller PE, of 29 times. The Shiller PE is a historical 10-year average. The only time that multiple has been higher than this was in 1932 during the Great Depression and during the tech wreck in October 2000. Now, although it's only one measure of valuation and may be justified with lower interest rates, it is still prudent in our view to be cautious of these elevated valuations. Other global markets, however, look better value, and we prefer Europe and Japan on a global basis. And indeed, in Australia, after 5 years of relative underperformance to the global market, the Australian market now looks relatively better value, and we favour at the margin to international markets. Within property, A-REITs, the listed property sector, also look quite expensive, trading at premiums to their underlying net asset value. Given their exposure to rising interest rates, we are reducing our exposure in that sector. Within the direct property market, cap rates have declined quite sharply because of international buyers, and we'd be cautious in the commercial and retail sector. Our preference in the direct market is in the boutique sectors of healthcare, medical and education. There's been much disclosure and comment in regards to Australian residential property prices, which we believe is warranted. Disposable incomes are under pressure, wage growth is quite weak, and household debt levels are high. It is an area of concern that we're watching closely. Within fixed interest, we have no exposure to government bonds. We don't believe the yield on offer adequately compensates you for the risk being undertaken in a rising interest rate environment. In fact, in December, when US bonds went from 1.4 to 2.6, the capital value of those bonds declined by 7%. Within our fixed income, we are reducing credit, whereby the credit spreads have come back close to levels seen before the GFC, and we are maintaining a high level of cash. We have a reasonably healthy weighting to alternatives, increasing our exposure there in order to reduce the volatility in equity portfolios. So in summary, we are seeing a change of narrative from deflation to reflation. There are early signs of synchronised global growth, and global interest rates are likely, therefore, to rise. Risks are elevated, whilst volatility is low. We believe it's prudent to be cautious and well diversified. So importantly, how to navigate? Well, we believe it's important to stay well diversified and patient, respecting the current uncertainties. Use any market pullback as a gradual investment opportunity for new funds. Seek value when investing, not chasing momentum, and we would remain overweight cash for now. We favour alternative assets, unlisted, that are not at the vagaries of the day-to-day market pricing in order to smooth volatility in portfolios. Select property, direct property, in the medical centres, healthcare and education space still provides some value. We prefer Australian domestic equities over international equities at the margin, and of course cash, which we have an overweighting position to. I thought I'd take the opportunity to also update you on a couple of news items within Providence. Will Porter is settling well into London. He's had now over 20 meetings with international fund managers and family offices, and also taken the opportunity to travel to Zug in Switzerland to see one of our preferred managers, Partners Group. Given the changes to superannuation, we are taking the opportunity to review all clients' portfolios and strategies with their accountants, and we'll be coming back to you before the end of the financial year with any changes that we think are relevant. And if you happen to be travelling at Qantas and Virgin and in their lounges, you may keep an eye out for the Business First magazine that will be featuring Providence on the front cover. In the meantime, safe passage, and I look forward to catching up with you in the next quarter. Thanks for joining me. For a full report of our outlook, please see our website.